Advanced Accounting 18 Consolidation Ownership Issues. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our Facebook page, our email, and our phone number. The source for this information was Advanced Accounting Chapter 9 from McGraw-Hill's book. And I'd also refer you to Intermediate Accounting 16, which discusses preferred stock. On that note, let's talk about preferred stock, and we're talking about it in the context of a parent or a subsidiary buying and selling preferred stock between themselves. Well, if you go back to Intermediate 16, we have a definition of preferred stock, and the phrase preferred in common language means better. So why is it better? Why is preferred stock better than common stock in this case? Two reasons, really. The first is that the preferred stock shareholder will get their dividend paid before common shareholders if there's a dividend declared and if the company has earnings. So the preferred shareholder is first in line. Usually that preferred stock is a percentage of par value or a dollar amount dividend. They, the preferred shareholders, stand in line in front of the common shareholders if there's a claim on assets when the company liquidates itself. The company sells its assets, pays off its liabilities, and there's money left. People are getting in line to make a claim on the assets. The preferred shareholder is in front of the common shareholder. And then we talk about the subsidiary. If the subsidiary has preferred stock outstanding, it's going to be owned by one of two people. It's either going to be owned by the parent company or by a non-controlling interest, and we've seen that before. If I jump over to Excel, here's our preferred stock subsidiary preferred stock example. Levi is our parent company, Hollywood Jeans is our subsidiary. And we're using the basic equity method, which means that Levi, the parent, is going to recognize a share of the net income and dividends from Hollywood, the subsidiary. So the first transaction on 11X1, Levi acquires 80% of Hollywood Jeans. We've seen this transaction before. They acquire for a book value of $240,000. The non-controlling interest has a fair value and a book value of $60,000. What's new is Hollywood Jeans issues a $100,000 par amount, 12% preferred stock at par. So $100,000 times 12% means a $12,000 preferred dividend, and you'll note that none of it is purchased by Levi's. We have some financial results. Levi's has net income of $140,000 and a dividend declared of $60,000. So now the first step is to allocate Hollywood's net income between the parent and the non-controlling shareholder. So Hollywood has net income of $50,000, and we also say down here that they declare out of that $50,000 a common dividend of $30,000. We're going to subtract the preferred dividend that we figured out right here, 12% of $100,000, which means in blue what's left for common shareholders of the Hollywood net income is $38,000. Levi's purchased 80% of the company, so they get 80% of what's left for common shareholders, or $30,400. What does the non-controlling interest get? Well, again, there's $38,000 left. The non-controlling interest gets the remaining 20% that Levi's doesn't own. So 20% of $38,000 is $7,600. And you'll note in terms of a common dividend that non-controlling interest is going to get Hollywood Jeans' common dividend, 20% of it, or $6,000. What's tough about this question is to distinguish between the preferred dividend from Hollywood, the $12,000, and the common dividend that Hollywood pays on the common stock, $30,000. Two different things. What about consolidated net income? Well, here's Levi's net income, $140,000 that we were given. Here's the Hollywood Jeans, $50,000 that we were given, for a total of $190,000 consolidated net income. But we have to subtract out the income that's owned by the non-controlling shareholder. And that number is linked. It's the 19,600. Now the way we got that number is the $12,000 preferred dividend that goes completely to a non-controlling interest. Levi doesn't own any of it. Plus the share of the net income that goes to the non-controlling interest. So once again, the preferred dividend, none of which goes to Levi the parent, plus the share of Hollywood's income that goes to the non-controlling interest. So a total of 19,600. That number gets subtracted from the total net income for both companies to get the income attributable to the controlling interest, which in this case is Levi's. I'm going to write that in. Finally, we can talk about the elimination entries. We've seen these before also, elimination entries. We're going to debit to reduce the income from the subsidiary. That was the 80% of the subsidiary's dividend. This number, if I go to F29 back over here, there's that 80% of Hollywood's income. We're going to take that off the books. 80%, the dividend declared on the common stock, 80% of that, we're going to remove that from the books. Normally we debit when a dividend is declared, so we're going to credit to get rid of it. And if I skip over here, F31, there's our common dividend, 30,000. 80% of that 30,000 is the 24,000 of the dividend that went to Levi. And the net difference between the income we're removing by debiting and the dividend we're getting rid of by crediting is $6,400, so we eliminate $6,400 of our investment in Hollywood. We're going to take off the entire dividend declared of $12,000 for preferred stock. We're going to take off the 20% of the common stock declared to the non-controlling interest. So this is non-controlling interest. Levi didn't own preferred stock. This is 20% of Hollywood's earnings of Hollywood's dividend that goes to the non-controlling interest. Non-controlling interest, non-controlling interest. Then this number is simply a plug figure, the difference between the 19,600 that we saw right here, the non-controlling interest share of income. We're taking that off the books by debiting. We're removing the non-controlling interest share of the preferred dividend, all of it, the common dividend, 20% of it, and the net difference is the debit to non-controlling interest. The last two entries are a little easier. We're going to take Hollywood's common stock and retained earnings off the books. They must sum up to $300,000. We didn't give this to you at the beginning of the question. We're going to take off the $240,000 that Levi paid for Hollywood, and we're going to eliminate that book value and fair value that represented the non-controlling interest. So these two numbers come from the top of the prior page. There's the book value of the stock. There's the fair value and the book value of the non-controlling interest. That's going to be credited to take it off the books, and we're going to debit to remove the common stock and retained earnings. And the last entry, we're simply going to remove the preferred stock that was issued by debiting. When we issue stock, it's a credit to equity. We're debiting to get rid of it. And we're crediting the non-controlling interest. That's the end of Advanced Accounting 18. You'll find our Essential Topics courses that are 3-hour-long sections through GoToMeeting you can access. Our YouTube channel, Ken Boyd STL, for one-on-one individual tutoring and small group using GoToMeeting.com. Here's our website, our email, and our phone number. Thanks very much, and we'll see you next time.